Hello traders, a very good evening from my side. I'm making this video on the evening of 29th of July 2020. It's midweek, so Wednesday. And this concept of approaching intraday trading and the two unique ways in which you can do that, or at least one of them is unique, was back of my mind for quite some time, but I always believe that everything has its right time. Today evening is the right time to share my thoughts on the two approaches towards intraday trading. Now, if you found this a little intriguing, that what are these two ways? First, let's understand something, that intraday trading has its pros and cons. Okay. In fact, back in 2004, when I started learning about the markets and charts and technical analysis, uh, often I used to listen to this sentence that no one makes money trading intraday. And you kind of tend to believe this. And then later I realized that these sentences, these lines, these comments and statements are made by those who couldn't make it. And then I met few people who could do it successfully, consistently, and of course they won't say it. And so it doesn't matter whether others can do it or not. It's most important thing is whether I can do it or not is the approach. So if I want to try it out, if I want to give myself, I want to spend some resource and time, energy, money, I want to trade intraday, I would rather give it a certain amount of time before I come to a conclusion whether it's my cup of tea or not. And to do that, of course, you will always want to evaluate the pros and cons. So intraday essentially is time bound, right? So time is not in your favor, unlike investments where you can hold on to it as long as you wish to. In intraday trading, you don't have that privilege. Specifically talking about the Indian equity markets, we are looking at a market which opens at 9:15 a.m. and it shuts at 3:30 p.m. and this is your window. This is your window of opportunity. So if you get an opportunity at 3:15 p.m., you're only left with 15 minutes. So far, so good can happen with your trade. So time is restricted. That's one. Of course, in terms of positive, there's no overnight risk. So you're not worried about whether the new $1 trillion package goes through the Fed and how the market's going to behave to that tomorrow morning, whether it's going to be a gap up or gap down, etc. And you don't worry because every day for you is a new battle. So there are some distinct, definite pros and cons. One important, I don't know whether to call it a positive or a negative, a weakness or strength, but one very evident aspect about intraday trading is volatility. Well, technically there is a term called noise also. It's a very noisy market, means it's doing a lot. It's going up, it's coming down, it's choppy, it's volatile, it's oscillating, and there are many fancy terms. And I have created or penned down my own term for this behavior of the market, and I call it drama. You can call it chaos, you can call it anything, but you get the picture. You get the picture that the markets are extremely volatile. And that is something an intraday trader invites, especially if you're trading the 5-minute or 15-minute time frame. If you've followed my past videos, you know that I prefer to trade the 15-minute time frame if it's an intraday trade. So you're inviting a volatility or noise or choppiness, and I call it, as I've written here, I call it drama. It does a lot of things and eventually it lands up doing what it had to do. So Emotional quotient or emotional roller coaster is something which an intraday trader deals with every day. He might do 3 trades, 5 trades in a day, few right, few wrong, and he has the stomach to go through that. He's not, I would say, jarred by this intraday volatility. So it's not for everyone. Of course, everything is not for everyone, and everything should not be for everyone. That's understandable. So intraday trading, whether it's profitable or not, that is a secondary thing, but it may not be aligned or synced with your personality or approach. You might be someone who hates to take losses. You might be someone who gets really, I would say, worried, and you tend to panic when the trade goes against you, and you're looking at the ticker and it's moving every tick up and down, and it probably gives you makes you, I would rather say, uncomfortable. Maybe it's not for you. That's okay. Maybe deep down, a value in investing is something which is for you. How would you know this unless you try? How would you know that? So now we know that what are the pros and cons. There can be few other points, but you know the picture. Essentially 9:15 to 3:30 for the Indian markets. Now the important thing, that the two main aspects that I'm going to share with you in this video is from the perspective of trade identification. See, what trade am I going to do tomorrow intraday, let's say? It's trade identification. How do I identify my trade? The stock, the levels of entry, the levels of exit in a profit or a loss. So these goes into my decision making. Now the way I see this, your trade identification, if you're an intraday trader, can be done in two ways. One is during the market hours, when the markets are live, and the other is post market hours. Very distinctly different approaches, very distinctly different approaches, and both of them have their pros and cons, and I have a certain liking for one of them. Let's talk about the first one. The first one that we have got here is this one, and this is the second one. Let's talk about the first one. The first one we just spoke about is during market hours. This is no rocket science. This is understandable. If you're looking at a, let's say, I'm using the tradingview.com platform here to walk you through the charts. And let's say this is HDFC Bank, and I have the 15-minute chart of HDFC Bank, and I might have my indicators, my RSI, moving averages, stochastic MACD, whatever you're using, whatever it is, you're essentially finding out or identifying your opportunity, your trade from this particular time frame. So you wait for the market to open 9:15, you wait out the first couple of minutes or 5 minutes, 9:20, and then you scout for a trade. Then you look out for an opportunity. It can be 5 minutes, it can be 15 minutes, it can be any time frame, but you are on the hunt for a trade after the market opens. So your point of entry, your stop loss, your target, everything comes from this particular time frame. That's during market hours that you're looking for. So let's say if you're trading the 15-minute time frame, I generally like TF for time frame, and you're looking for an entry. A good way to do this, which I generally suggest the mentorship community traders to do, is wait out for the first 2-3 minutes. The best would be 5 minutes. Okay, you will always see for an intraday trader, the volumes curve generally will be like this, where the first hour or half an hour and the last half an hour will see the maximum number of volumes or participation. This is primarily what I understand from my institutional broking experience is till 3 p.m. the institutions will have their orders and they would like to get their fills as much as possible. But then after 3 p.m., that is 3 to 3:30, they generally go aggressive in terms of their buying or selling, and that's why you tend to see sharper move in terms of price and larger volumes also happening. And of course, the first half an hour or the first few minutes of the opening is primarily because of the overnight developments that has happened, and the market is opening with its own positivity or negativity, right? So you wait for the market to open, and what I suggest our traders to do is always evaluate and look at the sectoral theme if the market has created some kind of a sectoral theme for the day. So today, 29th of July 2020, today when I was interacting with our mentorship traders in the morning, and right after the opening, we could clearly see a theme coming up in terms of the pharmaceutical stocks, which were holding, in fact, which were gaining. There was also a theme coming out from the banks also, but the pharma held strong throughout the day. So always check that which are the sectors which are helping the index gain or probably dragging the index down. So you get a sectoral theme. Okay, today it seems like the pharma is doing well, which means you would like to keep a close watch on the pharmaceutical stocks on the 15-minute time frame and find a trading opportunity within them, trade and get out. If on that day, let's say IT stocks are weak, let's say for example today, typically right from the beginning, our Reliance Industries was weak. If I show you the 15-minute chart of Reliance, and today the market opened right here. This was the first bar, this one, right here, this one. So right after the opening, this is the first 15 minutes, this is the second 15 minutes. So right after the opening, Reliance has more or less created a clear signal for itself, a theme for itself, and it kept on dragging itself down throughout the day. So identifying this, figuring it out is half the battle won, I believe, for an intraday trader who is scouting for trade during the market hours and looking for an opportunity from the 15-minute or whichever time frame you're trading. This is one way. I would say that this approach is a little stressful. Okay, because you are not prepared, the market's preparing you, the market's giving you information, and you're preparing yourself for a trade. So it becomes a little stressful, or in terms of work, it's much more. The second approach which I like, the second one, is post-market hours. So I had personally have the maximum, let's say, success in this approach. And in fact, one of our mentorship success stories, which is with Gautam, you would notice that he had also exercised the same approach. The approach is you find out based on the closing price, let's say, find out an opportunity from the daily chart. Okay, now this can be anything. This can be, let's say, some kind of a candlestick pattern. And if you are a candlestick trader, I would always suggest go for the bullish harami and the bearish harami. Very good patterns. If you put it in terms of simple bar price action, a very nice one is inside bar. So if you go back to the chart of Reliance Industries today, the fall, and if I show you the daily chart, Reliance Industries yesterday was a beautiful inside bar. And as I do this video with you today on the 29th evening, I believe Infosys has closed as a beautiful doji. Now look at this. This is the daily chart of Infosys. It's a strong up move, 3-day move up, and then you have a doji, which is something like a harami pattern also. Now this stock gives me an indication that it has this buying, it has slowed down. Definitely. So will it lead to a correction, or is this a consolidation and it will lead to further move up? So this approach is something that I do for intraday trade. So I find out the stocks which I keep on my radar for the next day, and then I will go to the 15-minute time frame and look for an opportunity. So let's say if I'm expecting Infosys to come down, that is the inside bar or the bearish army to break down, then my level of entry is the low of this bar. And then what I will do is I have it on my radar, I've put it on my screen, Infosys, and then I'm going to keep a close watch on the 15-minute chart of Infosys. And if it gives me some kind of a signal, I will take this trade. So this is one approach which I used to teach a few years back, where I used to call that the approach of a decider, approach of two time frames, where you call one the decider and you call other the executor. And in this case, I'm using, let's say, the daily chart to decide, and I'm using the 15-minute chart or whichever time frame you find preferable to execute your trade. So I come to Infosys. I'm going to keep this chart very, a close watch at it. And if I get any signals to sell, it can be any signal. I'm just telling you the approach. I'm not telling you, okay, you have to do this. You have to use MACD or RSI or so. That's not the approach. The approach, the objective of the video is to tell you the way. And then you can execute in your own way. You can use candlesticks, you can use Elliott principles, anything you wish to. But this approach of analyzing post markets and then trading it through an executor the next day helps in various ways. One very important thing is when you do this, when you're analyzing, it's a very sound analysis. Means I generally do this in the evening, post my dinner, or next day early morning if I didn't manage time last evening. I'm going to take my time. I'm not in a hurry. If you're doing it during market hours, you know very well, if you're a trader, how your internals function, how your emotions, your mind functions when the market is live. And when the markets are live and you have an open live position, how your internals work. And ask yourself, in those kind of internalities, would you like to take important decisions? Don't you feel that when you're trading, you don't want to get disturbed? If someone knocks at your door and asks for something, etc., etc., you don't want to, right? Well, I personally do not. So I don't want to be disturbed. I don't want to do anything else. And so taking a decision is something else. It's like deciding on another trade. So when I do it post market, it's of course far more sound. You're far more calm, and you can chalk down, decide on those stocks which are likely to give a move. And in this, one important thing that you can look for is volatility breakouts. Forget trend, forget momentum and all that. The best thing that you would find is if you approach volatility breakouts, means the range contraction. You can do a Google check and look for concepts like NR3 and NR7, which is narrow range 3 or narrow range 7, means the markets have a certain range, and after that the size of the candles start to drop, which means that the market is getting into a range, which means eventually it's going to give you a move and you're going to capture the move, and that's a quick intraday trade. So volatility breakouts can be done in various ways. You can use ATR base, Keltner channel, Bollinger Band. Again, this objective of the video is just to tell you the approach and not give you, let's say, a build-up setup. Why? Because there can be so many. There cannot be any one which is best. But if you understand the approach, you can create many such setups for yourself. Right? Also, if you are not a very active trader, let's say you are not in front of the system all the time, then this kind of an approach, a decider executor approach, will suit you best. How? Let's say you find out that based on your understanding, you feel that Infosys seems to be a little tired, it's got a bearish Arami pattern, and I'm going to sell below the low of the small candle. And for this, I'm going to keep the high or a little above the high as my stop loss. So this decision making is done. You expect a breakdown from Infosys. I don't know what's going to happen tomorrow or not. This is just an example. But haven't you done all the decision making before the market opens tomorrow? The answer is yes. So you can place the orders pre-market. You can tell your broker, if you use some kind of an algo system, you can place them there also. And then you can shift your focus on some other works, because you're not an active trader. You're probably into a business or job. But you have the orders placed, you have the targets placed, you have the stop loss placed. At least you're participating without being bogged down and glued in front of the screen all the time. Overall, I feel that psychologically, and while exercising, like while doing the homework, this approach suits better. This approach yields better strike rate also, because the higher time frame is supportive. The higher time frame has gone into a crunch or a volatility drop, and the higher time frame is saying that I'm going to move, and this I'm going to move movement you're going to capture from the smaller time frame. This approach, I feel, works far better for an intraday trader. But I have seen that by intraday trading, people always open the 5 minute, 3 minute, 1 minute, 10, 15 minute chart, and whichever trade they get from that chart, they trade without, many a times, without even looking at what the higher time frames are saying. The higher time frames are very, very important for intraday traders, because if you're long and your higher time frame, say for a 15 minute, the higher time frame is an hourly chart or 75 minute chart. If you're long and the higher time frame is stretched, is overbought, is at resistances, then no matter how good your setup has been, it will not find the strength to go up. It will come down, it will dwindle down, and then later, day after tomorrow, it will give you a move. So I'd suggest, especially for intraday traders, and if you are an intraday trader, please try this approach. The objective, the psychology of this approach is, I want to find those stocks from the daily time frame who has a larger probability to move tomorrow. How do I find this? Essentially through volatility drop. Second, you can use is extreme overbought and oversold, and you know, okay, this guy is likely to come down or go up. Now capture that from a smaller time frame. That's the approach that I've been doing. I love this approach, and it works for me. It's worked for many mentorship traders also I know of, and I'm quite confident. I know what I'm saying, that if you do this properly, it will work for you eventually, maybe not immediately, because if you're new to this. And number two, you will trade better. You'll be a far more sound trader, and not jittery, not compulsive, and definitely not an impulsive trader. I hope this was useful. If you have any doubts, something that you did not understand, I failed to explain, feel free to put it on the comments below, and I would love to hear from you. Thank you. Do take care of yourself in these difficult, different times. Till then, trade well, trade well.